For the last 15 years, investing has felt easy. You just buy the S&P 500 and ignore the rest of the world, and you win. We call this home country bias, and we assume the U.S. will always be the winner. But in 2025, something huge shifted. While everyone was watching the big U.S. tech giants, a completely different corner of the market quietly delivered returns of nearly 50%. And most American investors missed it entirely because they were looking in the rearview mirror. Today, I'm breaking down the 2025 market review to show you exactly why owning the whole world is the only way to protect your wealth in 2026 and beyond. So let's look at the numbers. This data comes from Momentous Investors, a firm that specializes in evidence-based investing. In 2025, non-U.S. stocks outperformed U.S. stocks by the widest margin we've seen in about 15 years. So let that sink in. For over a decade, your international funds probably felt like dead weight in your portfolio. You probably asked your advisor, why do we own this junk? Why don't we just put it all in the S&P 500? Well, 2025 is why. The rubber band finally snapped back. Valuations matter. The US was expensive and the rest of the world was cheap. And last year, the cheap stuff finally took off. But the story goes much deeper than international investments outperforming the US. It wasn't just international, it was specific types of companies. I talk from time to time about factors, specifically size, small companies, and value, cheap companies. According to the report, developed small cap value international markets were up nearly 50% last year. These are small, profitable companies in Europe and Japan that nobody talks about at cocktail parties. While the headlines were obsessing over AI and tech in the US, these boring little companies were doubling the returns of the major indexes. If you were purely in a total stock market index fund, you got a little bit of this, especially if it was a global stock index fund. But if you had a tilt towards value and small cap, like I often discuss, you captured a massive premium. Why is this hard? It's because of recency bias. Human beings are wired to think that whatever happened yesterday will happen again tomorrow. The US won last year, it will win this year. International lost last year, it will lose this year. This causes massive financial anxiety. You end up chasing returns, buying high and selling low. Real peace of mind, real financial health comes from knowing that you own the winner before it wins. By holding a globally diversified portfolio, you didn't have to guess that 2025 would be the year that international small cap or developing markets would outperform. You already owned it. You just had to be patient enough to let it work. The question is, what should you do now? Investing in the rear view means that you don't just look at last year and put all your money in international small caps this year because they did so well last year. But valuations are still attractive in international developed markets and emerging markets. So does this mean you should dump your US stocks and go all in on developed markets or emerging markets? Absolutely not. This is just chasing returns in the other direction. Here's the fiduciary lesson from 2025. Check your home country bias. If you're 95 or 100% invested in the US, you're taking a massive risk that the US will stay on top forever. 2025 proved that doesn't always happen. Consider tilting your portfolio towards value and profitability. These factors have historically paid a premium over long periods of time, and they shined brightly last year. Also, don't ignore high-quality bonds. They have solid returns as yields decline. Bonds are a safety net. Don't cut them just because stocks are exciting and doing well. The market moves in cycles and winners rotate. If your portfolio is built properly, you'll always have something that is lagging and something that is leading. That is the definition of diversification. If everything in your portfolio is going up at the same time, you aren't diversified. You're just lucky, and luck typically runs out. Investing isn't always easy. It's felt easy the last 5 years because the S&P 500 has done very, very well. But there's some hidden risks of having all of your money in the S&P 500 today. Most of the returns in the S&P over the last 3 to 5 years have been from a handful of tech giants. Those tech giants are starting to look richly valued. That's why they didn't do as well last year, even though the US stock market was up over 15% last year. But going forward, having a mix of diversification of value and growth, small cap and large cap, and international and emerging markets is going to be crucial for you to achieve the goals you want to achieve over the next 3, 5, and 10 years and beyond. A properly diversified portfolio includes global diversification. Pull up your brokerage account. See how much exposure you have internationally. If you have less than 10%, it's time to start adding more international. You don't need to do it all at once. Add 5% a quarter until your allocation of international and developed markets is closer to 20%, and emerging markets 5 to 10%, depending upon your stage of life and risk tolerance. And I would love if you made a comment on this episode. And for those of you watching, if you'd like a complimentary portfolio analysis, the first 5 people that type in the word portfolio in the comment section below will get a complimentary portfolio review. Once again, this is Brian, the Wealth Decisions Guy. Thanks for listening, and I hope to see you next week.